Hi, I'm Beat Nussbaumer from Macrobeat Limited. Today I would like to talk about yesterday's weak US retail sales data, as well as I have an indicator for you that is a bit more forward-looking in terms of what to expect for the medium term, maybe for the economy. If you could have chart number 1. So there what we see is a real shock result yesterday from the US retail sales. This is the largest month-on-month drop we have seen since 2009, which is obviously something the market didn't really expect. The reaction in the market was very instant, which we have seen weakening in the dollar, we have seen weakening in equity markets, and this is really something that the market hasn't really been prepared for. So far we really only talked about the global growth slowdown, abroad, with dovish ECB, dovish RBA, obviously the problems in China. And now the big question the market has to answer, or actually is asking itself, whether this sort of is the first indication that the global slowdown starts to actually knock on the door in the US. And maybe that explains as well why the Federal Reserve has moved more towards a neutral bias. And it's this kind of explanation for why the policy shift has been so instant and so surprising. If you go over to slide number 2, this is really an interesting one, and it is a Baltic Dry Index, which is an indicator that really shows the true economic activities, which is a shipping index, which tells you about what is actually truly happening in the global trade. There is a very nice correlation between equities, which is the same as risk as such, and this Baltic Dry Index. The Baltic Dry Index is a leading indicator, so it's about roughly 2 months ahead of the actual activities once it starts to show up in the actual data, in the individual countries. So if we were to go with this forward-looking index, it's easy to see that the market should really be worried about the equity market going forward. I have been negative for US equities for quite some time. The only reason why we have sort of bounced in the last few weeks is the positive spin the US puts on the trade talks with China that are still ongoing. Today we just finished the talks in China. There's some more talks going to happen in the US next week. There's chatter that there's a positive vibe on both sides, but the newspapers and journalists really report that the latest talks that have been around the sort of reciprocal, access to the economy, as well the property or intellectual property rights, those talks seem to have stalled, which I would really expect to actually not see a breakthrough at all. So I'm actually preparing for the trade talks to just show a more selective or sort of downgraded version where they agree on some topics, but I don't think some of the major topics will be really solved. How the market is going to react on a partial trade deal between the US and China has yet to be seen, but I think the shock from the US retail sales versus the positive elements of a trade deal between the US and China, I still think that equities will find it very hard to rally on the back of these latest US data. Clearly, one bad number doesn't really make a recession yet or recession fears, but I think we have to look out for those data very carefully to see whether the US is really starting to slow down as well. Into the currency market, I just like to show you a sort of reaction yesterday after the data, where we've seen dollar-yen dropping around 1% after the US retail sales. So far we kind of hang in there, but quite clearly the dollar might be under pressure against the yen, especially if it were combined with a drop in US equities. And I could really see in the medium term, in the next few weeks, probably the dollar-yen pushing lower towards the sort of lower end of the lows that we have seen early in the year. The last chart I like to show is the Aussie dollar. So far, as you can see, there hasn't really been much happening. The Aussie tried to rally earlier in the last few weeks on the back of this positive spin on the trade talks, but really struggled to do so, dragged down by the softness in the China economy and the worry around global growth. So I would think if we add a weaker US economy, that would really push more pressure on the channel risk complex around equities, and I could see Aussie pushing lower and actually challenging the sort of breaking below the 70 level and hitting multi-year lows probably over the next few months. That is from me. Have a lovely weekend. Thanks very much indeed.